BYD EVs are beating Tesla. Here's why Buffett is selling. Warren Buffett is famous for one thing: he doesn't sell winners. So when he does, the world pays attention. Because this time, Buffett is quietly walking away from BYD. The same company that just beat Tesla. The same company now crowned the world's #1 EV maker. So here's the question nobody can ignore. What does Buffett see that everyone else is missing? Stay with me, because BYD's rise looks unstoppable on the surface. But underneath, cracks may already be forming. BYD didn't start as a car company. In 1995, it was just a small battery maker in Shenzhen, China, powering phones, not vehicles. Then came a risky bet. In 2003, BYD jumped into automobiles, an industry dominated by global giants. Most companies would have failed right there. BYD didn't. Fast forward 20 years, and BYD isn't just competing with Tesla, it's beating it. In 2024 alone, BYD delivered over 3 million electric and hybrid vehicles, surpassing Tesla in total annual sales for the first time in history. Its expansion has been aggressive and global. Electric buses rolling through London, affordable EV flooding Brazil and Thailand, and factories spreading across Europe and Southeast Asia. BYD wasn't just growing, it was taking over. And that's when Warren Buffett entered the picture. Back in 2008, while most investors laughed, Buffett's Berkshire Hathaway placed a bold $230 million bet on BYD, buying roughly 10% of the company. That risky move turned into one of the greatest investments of his career. Over time, that stake grew into tens of billions of dollars. BYD became proof that even Buffett could spot a tech winner when the odds were stacked against it, which makes what happened next even more unsettling. In August 2022, something strange appeared in a Hong Kong filing. Berkshire Hathaway had sold a small portion of its BYD stake. At first, nobody panicked. Just routine, just trimming, nothing to see here. Except it didn't stop. Month after month, Buffett kept selling. Quietly, methodically, almost like clockwork. By early 2024, Berkshire had cut its ownership from around 20% to less than 8%. And every time the news broke, the market reacted fast. BYD's stock dropping 5% or more in a single day. That's when investors started asking uncomfortable questions. Was Buffett simply locking in profits after a 30 times return? Or was this something else? Because here's the twist. Buffett was selling while BYD was breaking records. He kept selling as BYD overtook Tesla. He kept selling as deliveries hit all-time highs. He kept selling as headlines screamed EV dominance. That's not how Buffett usually behaves. He holds great companies for decades, sometimes for life, which means this exit isn't normal. So what's really going on? Some analysts point to brutal competition inside China, where EV makers are slashing prices just to survive. Others warn about rising geopolitical tensions, trade barriers, tariffs, and political risks that could choke global expansion. And then, there's the possibility Buffett sees something deeper. A future where margins shrink, growth slows, and today's EV king faces tomorrow's reality check. Whatever the reason, one thing is clear. When Warren Buffett starts leaving the table, smart investors stop celebrating and start paying attention. Because sometimes the biggest warning sign isn't a failure, it's a success right before the turn. So one of the most straightforward explanations is valuation. BYD's market capitalization soared past $100 billion in 2023, a staggering climb from when Buffett first invested in 2008 at a valuation of around $2.3 billion. Even for a growth company, such rapid price appreciation can make seasoned investors cautious. Buffett has often emphasized the importance of not overpaying for even the best businesses, and some analysts argue that BYD's stock had begun pricing in near-perfect execution for years to come, leaving little margin for error. Another factor is geopolitical risk. The US-China relationship has grown increasingly tense, with trade restrictions, technology bans, and the possibility of tariffs on Chinese-made EVs in Western markets. For a company aggressively expanding into Europe and considering entry into the US, these risks could disrupt supply chains or block key market access. Buffett, known for his conservative approach to geopolitical exposure, might see reducing his stake as a prudent move in an unpredictable climate. Competition within China's EV market is also intensifying. While BYD leads in volume, rivals like NIO, XPeng, Li Auto, and even international players like Tesla are engaged in aggressive price wars. In 2023, Tesla's price cuts in China forced BYD to adjust its own pricing strategy, which in turn squeezed profit margins. The domestic market, once a goldmine, is showing early signs of saturation, and oversupply could pressure earnings in the near term. Finally, there's the simplest reason of all: profit-taking. Berkshire's original $230 million investment in BYD turned into a stake worth more than $8 billion at its peak, an extraordinary return by any standard. Buffett has always maintained that sometimes it's wise to trim even the best performers when the investment has massively outperformed expectations. Selling now could lock in gains while the market is still favorable, allowing Berkshire to reallocate capital to other opportunities. While BYD remains a dominant force in the EV market, there are early indicators that its relentless upward trajectory could face challenges. One red flag is the slowdown in certain overseas markets. For example, in 2024, BYD's European push faced unexpected headwinds as the EU launched an investigation into whether Chinese EV makers, including BYD, were benefiting from unfair government subsidies. This probe not only threatens potential tariffs, but also casts uncertainty over BYD's growth plans in one of the most lucrative EV markets. Profit margins are another area to watch. BYD's gross margin in its automotive segment reportedly narrowed in late 2023 as it joined an intense price war triggered by Tesla's aggressive global price cuts. In China alone, dozens of automakers slashed prices to maintain sales volumes, creating what industry insiders dubbed the EV bloodbath. BYD, despite its vertical integration advantages, still had to sacrifice some profitability to keep pace. There's also the issue of potential oversupply in the Chinese domestic market. With over 100 EV brands competing, production capacity is outpacing demand, leading to inventory buildup and discounting. This environment puts pressure on even the strongest players, as they must work harder to sustain both market share and profitability. Changes in government policy could have a material impact. Beijing has gradually scaled back EV subsidies that fueled much of the early demand, while BYD has the scale and cost advantages to weather such shifts better than smaller rivals. The removal of these incentives still risks dampening sales growth, especially in less affluent markets where price sensitivity is high. Despite the concerns, there's a compelling argument that BYD is not in trouble at all. In fact, it might be entering its most powerful growth phase yet. In 2024, BYD delivered over 3 million vehicles, including both battery electric and plug-in hybrids, making it the undisputed leader in global EV volume. This dominance isn't just about sales. BYD's product range covers nearly every price segment, from budget-friendly hatchbacks like the Dolphin to luxury SUVs under its new Yangwang brand. One of BYD's biggest strengths lies in its vertical integration. The company manufactures its own batteries through its subsidiary FinDreams, giving it more control over costs and supply than competitors who rely on third-party battery suppliers. This has insulated BYD from some of the raw material price volatility that has hurt other automakers, allowing it to maintain production even during global shortages. Its global expansion is also accelerating. BYD has opened or announced new manufacturing plants in Thailand, Brazil, and Hungary, positioning itself to avoid tariff barriers and meet local demand. In the electric bus segment, BYD is already a familiar name in major cities from London to Santiago, proving that its electrification strategy extends beyond passenger cars. Moreover, the company is entering high-margin segments that could boost profitability in the long term. The Yangwang U8, a luxury off-road EV priced around $150,000, and the upcoming U9 sports car signal that BYD is moving beyond volume sales into premium territory, a space where Tesla built much of its brand cachet. So while Buffett's sell-off has raised eyebrows, many industry watchers argue it may have more to do with Berkshire's investment discipline than any real weakness in BYD's fundamentals. If anything, the company's scale, innovation pace, and international reach suggest it's far from peaking. Buffett's gradual exit from BYD is not happening in isolation. It's part of a broader shift in how global investors are approaching Chinese equities. Over the past 3 years, foreign investment in Chinese companies has faced mounting headwinds due to regulatory crackdowns in Beijing, unpredictable policy changes, and worsening U.S.-China relations. From tech giants like Alibaba and Tencent to manufacturers like KTL, valuations of Chinese market leaders have been hit hard by investor risk aversion, even when their fundamentals remain solid. There's also a historical pattern in Buffett's investment behavior worth noting. While he's known for his forever holding strategy, there have been moments where he has exited early, such as with Disney in the 1960s and McDonald's in the 1990s, only to watch those companies soar afterward. This raises the question, is the BYD sale a strategic call based on current conditions, or will it go down as another sold too soon moment in Berkshire's history? From a geopolitical standpoint, BYD sits at the crossroads of several powerful trends: the global EV race, China's industrial dominance, and the West's push to secure its own green technology supply chains. If trade tensions escalate, companies like BYD could face tariffs, export controls, or political pushback in key markets. But if relations stabilize, BYD's scale and cost advantage could allow it to dominate not just in China, but across emerging and developed markets alike. Warren Buffett's sell-off of BYD may be interpreted in many ways: a disciplined, profit-taking move after a 30-fold return, a hedge against rising geopolitical risk, or a quiet signal that even industry leaders can face turbulence ahead. But it's equally possible that BYD's fundamentals remain strong, and that this is more about Berkshire's portfolio strategy than a negative call on the company's future.